What's going on, everybody? Welcome back to another video here. So in this one, I have a lot of really important information that we need to get out and analyze to everybody this afternoon. So Michael Burry and another very large banking institution, Goldman Sachs, are both coming out and saying that the market has not reached its bottom yet. Now, I would happen to agree with that, but what you have to look at right now is more short term. We could be seeing some very key pieces of economic data come out that are going to greatly influence the market, and we could see a little bit of a rally to the upside. We're going to go over all of these key data points, the very specific things that Burry has done and said, what Goldman Sachs is looking for, the key technicals on the market, and break this down like you guys will not see anywhere else. So if you guys do enjoy the information and analysis that I provide for you guys in these videos here, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who do want to learn. If you guys do want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So let's get right into the chart here and go over the market as we always do. So looking at the SPY here on the daily time frame, you did recently see this 1348 cross down here like we've been talking about, and you're really not seeing any significant signs of the market picking back up in the other direction. Now, what I mean by that is, yes, you are seeing the MACD start to fizzle out here, but the RSI still below 50 and below its moving average here. So until we really see the RSI on the daily pick back above its moving average and above 50, we are still going to be in that bearish trend. Now, in general, why are these large financial institutions coming out and saying that we most likely haven't reached a bottom yet? Now, there's a lot of key economic indicators and kind of data points that we're going to be talking about a little bit later. But again, looking at this chart right here, specifically on this daily time frame, well, you still are in this downtrending position here. There really is no signs of everything picking back up to the upside. Could we get that little relief rally and a little bit of another bear market rally similar to what we saw off of those lows here? Yes, absolutely. But you have to look at the big picture and the track record and the runway that we have going forward with policy decisions coming out. And again, 1348 is going to lead the way through these volatile markets here. I do want to shout out a couple of our members say that are absolutely killing it. Guys, when we say that we're the best place to come and learn how to trade, we're not messing around. Our algorithms geared towards retail investors are next level, having lots of success. We have a 6.82% gain on the day. We have a lot of good SPY trades. A lot of people are having success every single day. If you guys do want to come and take advantage of all of the opportunity in the market and really start to have a lot of success, make sure you guys check out that link down below, and make sure you guys head over and check out our algorithms too. Once you guys are in there, they are filthy. Now, I do want to kind of get into this Michael Burry situation right here very quickly. So Michael Burry and Goldman Sachs agree we have not hit the bottom yet. Now, there was a long research paper put out by Peter Oppenheimer, and what he's essentially saying is that there's a lot of different economic conditions and different technical market conditions as well that need to be met in order to basically differentiate between whether we are in a bear market rally or a kind of market reversal here. Now, we can go through all of that data here, but we're going to kind of break this down a little bit more simply a little bit later. But coming down and taking a look at some of the things that Michael Burry have said, he has said here in this tweet, crypto crash check, meme crash check, SPAC crash check, inflation check, 2000 check, 2008, and 2002 also check. So what he's saying here is that in a couple of these different times, again, crypto was not around in 2008, but a lot of these other times we were seeing very, very similar things happen where we haven't bottomed yet. We have not bottomed yet. Watch for failures, then look for the bottom. 2 SPAC ETFs failing is not near enough. What he's referencing here is that there needs to be more widespread, basically disaster in the overall market, seeing these types of investment vehicles really struggle in order for all of these different key players in the market to come in, swoop up all of these companies at these super, super low valuations. You are still seeing all of the things that have propped up the market over the last 2 years still persist. Now, what did Michael Burry actually do? Well, he actually sold pretty much everything. Now, these 13 Fs are not going to give us a full indication of what these large financial institutions are holding. They're not going to tell us short interest. They're also not going to tell us any of these large derivative swap positions or any of those other basically over-the-counter derivative positions that these institutions are holding. But there's a couple of things that we can realize and understand from Michael Burry's Scion Capital Management's 13F filings. Well, we see here that in the first quarter, they were holding a low amount of positions, but they were still holding a diversified portfolio here. when you come over and take a look at what they are holding now, it's one company, and it's a prison industrial complex company. Now, this can mean two things. One, Michael Burry has gone short on the overall market and is kind of planning something similar to what he was doing back in 2008. Or he flew to cash and is waiting everything out. Because you don't really have an indication from a lot of these tweets that he's sending out. They're usually cryptic, and he's probably not going to come out and talk his book to everybody on Twitter. It doesn't make any sense for him to do that. But those are the two kind of outcomes that we are seeing here. He's either in cash or he's shorting the absolute nuts out of the overall market. Now, when Goldman Sachs, Michael Burry, and a lot of these other big financial institutions come out and say that we haven't hit a bottom yet, they have a point for a variety of reasons. One, if you look at this 30-year fixed mortgage right now, and take a look at exactly where these rates are, well, you can see that mortgage rates over the last year have very, very significantly increased. You can see that they're currently sitting at about 6.25%. And what this means in general is that as these interest rates are going to go up, if you could qualify for X amount of dollars of a loan before, you no longer can. So your demand pressure in the housing market is no longer there at those price points. So what essentially happens is the prices have to eventually come down because there's not as liquid of a market at those higher price levels. Now, here's where we're going to get into maybe a little bit of a contrarian statement going into next week, and this is what I want all of you guys to start focusing in on, and it has to do with oil. Now, we all know right now that oil has been a very key driving factor in the overall market. We know that there's an energy crisis going on in Europe right now. There's a lot of political moves being done by OPEC in Russia and China now, kind of hopping into this little oil battle that we have right now. But what have we seen out of actual oil prices, and how does that affect the decisions that we are going to see maybe tomorrow by the European Central Bank, and once we see our Fed meeting start to come up? Well, when we look at oil prices over the last month, and we come back over to this screen right here, we have seen a drastic decrease in oil prices. We went from all the way at the top in the beginning of June at 117 for WTI, all the way down to 81 where we're sitting right now. Remember, oil is a very, very key part of CPI, the Consumer Price Index, which is going to be a good indication of how high inflation is. Next week, however, we are going to be getting this CPI print. Let's see right here what exact day this is going to be. I think it's next week over here. Let me come down. I believe it's on Tuesday. Yep, so next Tuesday, we are going to be getting the Consumer Price Index data at 8:30 in the morning. Now, since oil has significantly decreased, well, we know that most likely as we get into these colder months here, the demand for oil is most likely going to start to head up. But we don't necessarily know how high these oil prices can go. With OPEC cutting production, that it can be taken as a sign that they've seen oil prices come down low enough, and they are looking to see these prices start to pick back to the upside. But the fact remains is that oil prices have significantly decreased. So it's very possible that we could see a CPI print next week that comes in lower than expected. Now, here's what we also have to realize. When we think about lower CPI, higher unemployment, and the Atlanta Fed actually cutting growth estimates today, you are seeing decreased growth, higher unemployment, lower inflation. Potentially. But that's exactly what the Fed wants to see. So there's a really big debate going on right now and a lot of uncertainty in the market as to what's going to happen over the next couple of weeks. Is Powell going to raise interest rates by 75 basis points? Well, that's what the probability metric tools are telling us. There's about an 80% chance right now. If you guys were following me on Twitter, I did tweet that out this morning. There's about an 80% chance, according to the market as a whole, that the Fed is going to be raising interest rates by 75 basis points coming up in September. But when you look at all of the data points as a whole, you have to think about whether or not you're looking short-term or long-term. Long-term in terms of maybe even a year, which still can be considered short-term. We aren't out of the woods yet. We still need to see a lot of things start to settle down. If the dollar keeps ripping the way it is, well, the Fed has basically ran the risk of losing price stability in the overall market. If unemployment gets too high, we get pushed deeper into a recession. If we continue to see declining GDP, more recession data yet there. And if oil starts to pick back up to the upside, well, then we're even deeper in that hole than we already were in before. So looking at this data here, most of what we can determine from a lot of this is there's a lot of uncertainty in the market, and that leads to a lot of volatility coming up going into midterm elections and into the end of the year. Now, you guys can take advantage of that all of the time if you guys understand where these things are going to go on a day-to-day basis. Now, again, that's what we talk about with 1348 in our private group all of the time. So again, if you guys do want to hop in there with us, make sure you guys check out that link down below. But overall, this market is going to be pretty wild going into the end of the year with a lot of this data and these key big macroeconomic trends starting to develop. So guys, that is going to wrap up this update here. If you guys did enjoy the information and analysis that I provided for you guys in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. If you guys do want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So guys, that's going to wrap it up for this one. Other than that, see you in the next one. Peace.